This is global. China is collapsing. I mean, we pointed this out years ago. Why do they steal intellectual property? We know how to answer that question. But the housing market there is horrible, and they have no good fixes. Their stimulation is beyond. Remember, look, and their currency is starting to plunge too. Europe is collapsing. What gets Europe out of this? Maybe some kind of enduring peace, but Putin has to leave. Gone, completely gone. But for that to, people can't trust him. And so I view this as 1929, 30s kicking in, and the Fed the most reluctant in history to provide liquidity, partly because they learned the lesson of too much liquidity. I'm calling 2022 the great reversion, and I view this as very similar to 1929. Yes, that's a good point, and it's a good point to say it's less likely to see a crash in U.S. equities, but typically dollar flows will flow to fixed income T-bills and two-year notes. Not really long bonds, but when you can get literally 4.3%, I pointed this out a few months ago, is the highest rates in the world, the deepest bond market, and most likely that inflation is going to collapse is in the U.S. And the Fed's there for you. I mean, you're not going to go to the British pound right now. Look what happens there. So maybe you will because of relative value, but that's the key thing. But why are equity markets declining? Why is the dollar? Part of the reason the dollar is reacting is because we have just gone through the biggest pump in liquidity, money supply ever. Got like 26% ever. I mean, I go back to 1960, and now we're in the middle of the biggest dump. We're taking liquidity at the greatest pace ever. Now I'm only 60, which means risk assets have to go down. So it's that, that sugar high that every single time the market went down 20%, the Fed would ease, is going away. So people get that. There's sellers up above in the equity markets. The beginning of an enduring deflationary recession in response to the excesses of excess that peaked in 2021. Cryptos are a good part of that. They went up the most, they've gone down the most, and they're probably going to stabilize. So I think some of the best performing assets will be long bonds, gold, and Bitcoin. I think the stock market's going to have a pretty significant correction akin to 1930s. And it's a simple peak. How about in 2000, it took 13 years to take out that high? Well, we should have similar. The thing I like to mention about the DXY, you just inspired me to do this, it's relative movements that matter the most. And right now, the DXY relative to its 100-week moving average is 18% above that. It's only happened once in history at the peak in 2015, right before the collapse. So it's pretty well extended. 100 weeks is pretty standard. It's almost 2 years. It's 2 years. But that's the relative strength of it. The thing is, DXY is measured virtually against the Europe. We all know Europe's basically a basket case. I mean, they don't have, I shouldn't say a basket case, but there's so many independent countries. I mean, I lived there. We all know why most of us Americans have emigrated from there because of the wars and forever. But comparing to another, bigger baskets, like we have a Bloomberg index and the trade-weighted broad dollar, I see it's not nearly as much as it rallied as much into the peak in 1985. I remember that well. I was in France as a student. But this is what's breaking, and this is part of what the Fed ignores. And the number one way to make this stop happen is the U.S. stock market going down relative to the rest of the world. Yes, there's other things in the big picture, but that's been one of the key drivers over time, is the U.S. stock market outperforming the rest of the world. Now, yes, it might be a little bit lagging when people start taking their money out of U.S. assets, but where are they going to go? Honestly, okay, in the short term, even the bond market, it's the lesson I learned trading treasuries years ago. There's no bond market in the world that's even close to the U.S. Depth, security, volatility, getting 4% on a 2-year note right now. Thank you very much. I mean, what person in the world is not going to do that? So people only sell treasuries because they say, they have to. And so I look at it as this is part of breaking right now, and this rest of the world. This is part of, to me, is going to be the Great Recession kicking in this year. The world has changed. The Fed will not be there to save you once we get death threats, and they will get death threats. Paul Volcker got them. The beginning of an enduring deflationary recession in response to the excesses of excess that peaked in 2021. Cryptos are a good part of that. They went up the most, they've gone down the most, and they're probably going to stabilize. So I think some of the best performing assets will be long bonds, gold, and Bitcoin. I think the stock market's going to have a pretty significant correction akin to 1930s. And it's a simple peak. How about in 2000, it took 13 years to take out that high? Well, We should have had similar extremes. What we've never had is the foundation. I mean, foundation for virtually all dumps in history is going up too high on the back of easy money. We've just never had money this easy ever. Now, I'm not blaming anybody for that. Remember, it was only about a year ago we got vaccines, and there was a lot of fear out there. So, yeah, the Fed had to make the risk of pumping up all the liquidity, but we didn't get that. We had a blip of a recession. Now we're going to get a significant recession globally. And I fully expect there's going to be a lot of good to come out of this. In the meantime, we've got to have a lot more pain to reduce inflation. We'll get that. I think inflation is going to drop at extremely high velocity. People don't realize that yet. Like the base effect in crude oil, going from 50 to 130 is pretty significant. Going back down to 50 is what it's going to do. So I fully expect things like crude oil to do what they always have been. It's one of the most significant mean reverting commodities on the planet. The mature long-term rational money managers understood this punch bowl is being taken away, and the party lasted for 40 years, so it's going to last a while, and it's very likely to head towards recession. But if you look at it this way, I look at it, if I'm an international investor, maybe some combination of U.S. equities, but I think long bonds are going to be some of the best performers. I've been wrong, but typically once this triggers, once we get that little flip, it's going to happen so fast. I expect rates to drop double the velocity, or maybe quicker the velocity than they went up, and then we have this enduring deflationary recession kicking. It's the same price as 2007. Imagine if we said that about the stock market. 15 years unchanged. That's called deflationary forces. So I think what Jeff Booth pointed out in his book, The Price of Tomorrow, of all kicking in. Hopefully, we won't have a nuclear risk out of Russia, Ukraine. If that happens, it tilts the world to a more extreme recession. It boosts prices like grains and T-bills, and who knows how bad that can get. But to me, that's my base case, and I don't see anything to stop it at this point. Now the key thing is when I mentioned this September, when I mentioned this 9 months ago, people use the idiot factor on me. Now it's less the idiot factor, and it's just pointing out facts of history. So I think gold's going to come out of this head. Typical commodities do what they always do. They mean revert, and they get cheap. So I think what's going to have to happen is risk assets are going to have to get real cheap. Housing should collapse. I mean, look what interest rates have done. And it's just a matter of time that all the lagging indicators follow that. I mean, inflation is very much lagging. I think everything is basically going to follow copper. It's down 24% in the year for a reason. Crude oil probably end up down 24%. And this is just what happened in 2008. But remember, that was just U.S. centric.